I'm Steve Sanders with First Financial Services, and we're doing another segment of Opening Doors, where we try to share with our clients and investors some of the factors that influence our day to day decisions and provide some insight into what's going on in the financial markets and generally the financial services space. So, in prior segments, we talked about how rapidly rising interest rates had a significant negative impact on the bond market. Today, we're going to transition that to a discussion of how rising interest rates can also affect stocks. So what you see in this first chart is the orange line is the 10-year treasury during 2022. And we're using 2022 like we did in the bond market because it was a good lab for what was going on in stocks and bonds. So the 10-year treasury more than doubled over the course of the year because of rising inflation. And you can see the impact on the stock market. It was down about 19%. Now, all of the reduction in stocks was not solely attributable to what was going on in interest rates, but it certainly was a major factor in the weakness in the stock market over the course of the year. So what we did in terms of researching this is the same thing we would encourage you to do. Use one of these large language models. We call it the easy button. And the one that we like is Perplexity AI because it gives quality information in our view, and it also sources everything. So if you want to dig deeper on a particular topic, you can. So the question we asked it was, what kind of impact do rising interest rates have on stocks? And it gave us a series of answers. First, reduce corporate profits. So when interest rates go up, the cost of debt goes up for businesses. The cost of debt also goes up for companies, and that tends to negatively impact profits and stocks. Second, and this is probably the most important factor in 2022, was it lowers the present value of future cash flows. So as a stock analyst, we have a lot of ways that we can value a particular stock. If a company makes $1 in earnings and it trades at $20, that's a price to earnings multiple of 20. In the banking business, the valuation multiples tend to be more around book value. But ultimately, what's a business worth? It's worth the cash that it generates. So in an environment prior to 21 and 22, when inflation was very low, $10,000 a year from now was probably worth about $10,000, maybe a little bit less. But when inflation is running at 8 or 9%, that $10,000 today is worth significantly less a year from now, maybe $900. So as a stock analyst, when we're projecting the cash flows of companies, those future cash flows become more significantly less in a period of high inflation. And that's why you saw particularly certain segments of the market like technology take a hit, which we'll talk about in a minute. It also makes bonds more attractive. So as everybody remembers, for a long period of time, we were getting less than 1% on our checking deposits, and 10-year treasuries were trading below 2%. So as an investor, if I'm looking at the relative attractiveness of more conservative and arguably safer bonds versus stocks, a 1 or 2% return is not very attractive to me. So that tends to push people into stocks. So as interest rates went up and treasury yields went up and bond yields went up, investors that were a little more conservative decided to shift some of their money into bonds, which makes perfect sense. It also negatively impacts business spending and consumer spending, the things we talked about before, just higher debt costs. But it can affect different sectors differently, and we certainly saw that in 2022. The sector that had been leading the market for really the last 10 or 12 years was the one that was hit the hardest, and it also happens to be the most important sector of the market, which is technology. So what you see here is the different sectors of the market. These are just the iShares. You can go to BlackRock's site and you can look at the iShares and see all of these. And we've ranked these in order of relative importance, meaning technology is about 30% of the market. And then down on the bottom, real estate is only about 2 or 3% of the market. So you can see in 2022, technology was one of the hardest hit sectors, down 35%. You also see consumer discretionary about halfway down the chart was down 32%, and that's for the same reason, that consumers were feeling pinched by the higher inflation. Communications is a combination of things and includes some companies like Verizon and AT&T who are negatively impacted because they have a lot of debt and their debt costs are going to go up. But it also includes a lot of technology companies. So there's a significant amount of technology in the communication sector. What held up fairly well during the course of 2022 were more defensive sectors like healthcare. It was only down 4%. Consumer defensive, those are the staples that we buy every day, those tended to hold up pretty well, and they were actually up. Probably the one surprise in 2022 was near the bottom, third from the bottom, the utility sector was actually up a little bit. Typically, utilities have a lot of debt. You would expect them to be negatively affected. But another dynamic that affects markets when stocks start going down is investors go defensive, and utilities are also viewed as defensive. So that was primarily, in our opinion, because people were moving into the more defensive sectors like utilities and consumer defensive. So there's also a market psychology impact, and that really revolves more around whether a rapidly rising interest rate environment is going to tip us into a recession. So that negatively impacts stocks as well. And generally, with earnings potentially going down, we see valuations moving south as well. So now we're in an environment where we expect interest rates to start going down and start going down very soon. So how do falling interest rates impact stocks? And this becomes a little bit more complicated. But the simple answer is typically when the Federal Reserve is lowering interest rates, it's because the economy is getting weak and we're either in a recession or we're headed for a recession. In that environment, stocks are going to perform poorly because they almost always perform poorly in a recession. However, in a soft landing scenario, and there's a lot of debate now about whether the Federal Reserve is going to negotiate a soft landing here, where the economy slows but doesn't go into recession, stocks typically perform very, very well in a falling interest rate environment. So overall, we would say, rising interest rates tend to negatively impact stocks. Falling interest rates under a scenario where we don't end up in a recession would be positive for stocks. So time will tell, but our position now is the economy is slowing, but still holding up pretty well. The job market's still pretty good, but we'll see. Thanks very much for taking the time to listen to this edition of Opening Doors, and we look forward to talking to you again soon.